really kind of digging down into those that are presenting something unique and different. And of course you've got a long history with regard to factoring and commercial finance, and your experience. Obviously, I was reading up on your resume, your affiliation association with LSQ, and then for lack of a better term, it looks as if you were kind of introduced to the factoring world through Tempeh, I believe. But to start with, tell us a little bit how in the nobody goes to college, law school, and nobody says, "Hey, let's talk about this unique industry factoring." Nobody talks about it. How'd you find your way into our world?
Well, what happened was when first 20 years of my career, I was a trial lawyer, and as part of that, I represented banks and financial institutions. Probably the last 10 years of my practice, I left the practice. And I left to go to work with a client who was an energy broker. Long story short, we grew the company to 200 people, 11 cities around the world, sold it to a competitor 8 years later. Then I started my consulting practice. And even before I knew Tempeh, a few years later, I did some consulting work for a garment broker.
Okay.
And so as part of doing work for a garment broker, I came in contact with IDB Bank in their factoring division because they were factoring the broker's accounts. And so that was my first experience with factoring. And then, of course, my next experience with factoring was with Tempeh.
You've seen, given the time as well as the depth of the experience, you've seen a lot of evolution, a lot of change in our industry, and obviously with one of the ventures that you're involved with now, right? MCA stacking, and that's what you're going to present to the IFA here in a week and a half or so. So, from your perspective, what would you say in the last, couple of generations, really? What has been some of the highlights of the changes and some of the good or bad things you've seen come out of our industry with regard to how we help clients, with regard to kind of what our norms are, and in a general sense, where do you see the industry going if you put on your soothsayer's hat and thought out your crystal ball?
Well, historically, of course, many years ago, factoring had a negative connotation, if you use that word. And it wasn't because the public necessarily had any reason to believe factoring was bad, just because they didn't understand it and knew what it did. In reality, factoring has always been a terrific alternative financing option to companies that can't afford or can't qualify for bank financing for a myriad of reasons. What has happened in the 16 years I've been in this space, there has been a tremendous transition from old-time factoring to it becoming a technology-supported business. And the best example that I know is LSQ, because I was there during this transition.
Sure.
LSQ does not view itself as a factoring company any longer. LSQ views itself as a technology-driven alternative space for financing, for working capital. And it really is, because LSQ and now today many companies across the country have invested tremendous amounts of capital in building platforms to drive business through their technology. And so, again, if you asked LSQ today and many other factors today, are you a factoring company? They'd say, no. We're a technology company that provides financing and working capital. Now, it may be semantics, but in reality, substantively, it is different. And that's the biggest change. going forward, as technology develops further, it's going to be less of a hands-on business, I think. It will be purely a technology-driven business online where, there's real-time information, 24 hours, 7 days a week, which there already is, and all of the transactional work will be in front of your computer, on your handheld device, and who knows what technology we'll have available to us 5, 10, 20 years from now.
Yeah. And, we as an industry, certainly 20 years ago, would have never dreamed having relationships with clients based solely on the back of technology. It was always, by the phone, if not by in person. What does that mean when you think about it? One of the things that I love about the factoring industry, and I'm biased. I don't have anything, commercial finance, but one of the things I love about factoring, with my biasness, is that it's not a daily occurrence with a client, but there is a need to connect with that client, because that client's going to have an experience, something, generally speaking, something bad, something stressful, something that was unplanned, and that client needs help. How does the advent and the continuation, the evolution of technology, your example of LSQ being a technology company that provides working capital, how does that change, or does it change, with regard to a client's ability to stop and shake the factor by the shoulders and say, hey, I need your help, I need some attention right now? Does technology get in the way of that, or does it actually improve it?
That's a great question, and it's something that I have debated over and over for at least the past 5 years. I'm old school. I come from the pre-computer age, where it was all about relationships. Relationships were built through communication directly, and back when, by telephone. It was either in person or telephone. I am still a strong believer that the best form of communication is a direct communication, as opposed to the way the millennial generation has developed communication through texting, email. Rarely, if ever, they get on the phone. And of course, in the past year, rarely, if ever, does anybody get in person meetings. I think technology is phenomenal. However, I also believe there's still a strong need in building any partnership, and that's what a financing arrangement is with their customer. It should be a partnership. I think it still requires direct relationship building. And I'm a strong believer, even today, with the benefit of technology platforms, that you still have to see your client, you still have to meet with your client, you still need to build that rapport and that support if you're going to have a long-term relationship with a particular client. And so I think that will always be a necessity. And even on ancillary issues, one of the largest issues that always faces any lending relationship, including factoring, is the potential for fraud.
Yeah.
And as much as these programs that are developed and that are used by these platforms supposedly eliminate at risk to a significant degree, I don't believe that you can eliminate that risk 100%. And so if you aren't out there looking under the hood and kicking tires physically, you have the potential for going bad.
Sure. There's speaking of old time, there's a factor here in Dallas. So if you've been in factoring in Dallas and you don't know this name, then you need to do some history searching. But Goodman Factors and Harold Goodman, of course, is long gone in terms of our industry, but his influence is continuing on, and with his protege Keith Reed, who's retired recently. But Keith used to say when we were young men about fraud, and he would say there's fraud in your agent. The question is can you find it? So it wasn't the question if there's fraud. He would always say there's fraud in your agent. I don't know if that's necessarily true. I don't know if I subscribe to that, but I certainly understand the perspective, and I think you're right. Technology and all the improvements that technology allows in terms of analytics and looking at your portfolio. At the end of the day, people are still people, and people, for what it's worth, sometimes people make mistakes, and technology does not, in my opinion, is never ahead of ahead of a brain that is ingenious and is figuring out how to make things work to their benefit. Very little fraud is intentional, meaning, hey, let's figure out how to defraud this factor. Some is, but as you and I both know, it's generally out of circumstances and needs, and generally even good people think, oh gosh, I'm just going to do this, and then of course it spins out of control.
Going forward, historically and going forward, that I see in factoring, not every company will qualify for bank financing. Sure, they'd love to, because who wouldn't want to get single-digit financing in the bank?
Sure, yeah.
But the benefit that factoring has always brought to the table, and as far as I'm concerned, will always bring to the table, is that if not everyone can fit into bank financing, there has to be alternative financing. And some of the practical benefits of factoring are like this. And I've been asked this question over the years when people have said, well, why should I factor versus why should I go to a bank if I can qualify for both? And my answer has always been, factoring is a much more flexible relationship than banking. Factors move fast on their feet. And by that I mean, for example, you establish a line with a bank and you start pushing up against that line because your business has grown, which is great, but you need the bank to increase your line. That could take months with the way banks operate. Whereas with a factor, although they will give you, in a sense, a ceiling on your accounts receivable financing, the reality is it's credit driven of the account debtors, your customers. And therefore, if you are growing with your customers, as long as that credit still remains good, then the factor will grow with you on a daily basis rather than having to wait months to see if it can take place. And so in that sense, factoring serves a significant need to the marketplace, first and foremost, because, again, not everyone can qualify for bank financing. And number two, it's a relationship that really can grow in a very flexible manner.
True. So I don't want to steal what it is that you're going to present at the conference.
It's okay.
But tell us just a little bit about MCA stacking. Tell us a little bit about this new-ish venture, and give us a little tease as to what it is you're going to present here in about a week and a half or so.
Sure. MCA stacking really was developed almost 2 years ago as a result of a referral from a factor who discovered that one of their largest clients had over $6 million in MCA spread over 5 different MCA companies. And much as a factor or a lender bank knows their business they generally, from my experience and from what I've seen in the marketplace, really have no clue as to how to handle what happens when they discover that their credit is encumbered by MCA debt, even though it may be junior debt. Because the fact that MCA debt exists is the credit risk of the senior lender factor. So the factor came to me and they said, what do you know about MCAs? I know first and foremost, you want to stay away from them. They ended up referring me this client. I engage directly with the business. I don't engage with the factor as a consultant to their client because I look to protect the potential lender liability of the lender, the factor. And so I don't want to be in a position, nor certainly does my referral source, want to be in a position where if I have a customer who's unhappy,
Sure.
you forced me to use Marc Mellman, and so therefore you're responsible. So we keep an arm's length transaction. And I work with the business to extricate themselves out from under this MCA debt on a short-term basis and a long-term basis. Short-term, typically reducing whatever their contractual daily or weekly payments are to a much lower amount, and long-term, spreading the length, the timeline of the payments back over a prolonged period of time, and or paying off the MCAs at less than 100 cents on the dollar. In that particular case, I started with $6.3 million in debt. I cut off the payments entirely after 3 weeks. We only were sued by one party, but they didn't move forward with their suit. I kept them at bay for an entire 12 months until they finally got tired of not receiving any payments, and we settled the entire $6.3 million for 5 cents on the dollar.
Wow. Wow.
It gave the company time to get back into their normal business because they didn't have the stress of, I think it was $280,000 a week in payments. And so their cash flow smoothed out. They ended up paying far less. Their business had been better. And of course, the factor who referred me the case was thrilled because they had a much stronger client and their credit risk had gone down.
You know, I'm gonna make an assumption, and I'm bumping up against time, and I appreciate it. I'm gonna make an assumption in that experience. You know, if that company, if that client was having to make $480,000 a week in payments, obviously I don't know the numbers, but that's a huge amount. Is it safe to say, Mark, that frankly you helped that client avoid a worse outcome, maybe even 11, maybe even 7? And as crazy as it sounds, the MCAs at the time probably didn't know that they were looking at a problem in a matter of weeks, days, months. But is it safe to say that you actually helped the MCA? Because ultimately, had you not done what you did, the company wouldn't be able to survive.
Well, that was one of the selling points that I used in my negotiation. I basically said to the MCAs, you want to file suit, go ahead. Day after you file suit, they'll be in a Chapter 7 because they're going to have to close their doors. And you are so underwater on all your debt because the factor has a senior perfected security interest in all the assets of the company. And the factor at this point is even in an over-advanced position. And so they're underwater. So you want to take them to court? Be my guest. You'll get nothing. And that's how I was able to keep them at bay. Now, I don't do that in all the situations. That was an extreme situation. But that's why I was able to buy time. So just as a brief preview as to what we'll be speaking about next, Barry Reisman, who's an excellent lawyer in New York, who I've worked with in this space, he and I are going to present a panel, and we're going to talk about the current state of the MCA world, what we're doing. There's been a lot of discussion out there that in the course of the past year's pandemic, MCAs have really gone out of business. They're not present anymore, which is not true. We're going to try to give the factors and lenders at the conference an up-to-date assessment of where the MCAs are, what they're doing as far as providing financing, and then spend most of the time talking about if you have, if you're a factor and you have clients that you discover have MCA debt, how someone like me can help you and get out of that. And more importantly, I get a lot of referrals from factors who have prospects they want to bring on as new finance partners. Then they discover in their due diligence there's MCA debt out there. And so I help clear the MCA debt, and then they can enter into the relationship. And I'm going to be talking about it. Should be pretty good. And I suspect there are a lot of people out there that will be some new information for them.
I think I heard the other day that the in attendance physically is up to 450 people, which is fantastic. The year out,
it is fantastic.
The advent of COVID, I'm excited. I know that I've circled your session a number of times as must not miss, and I know many of my peers are as equally excited to hear you and the presentation you and Jerry are going to give us.
Well, I appreciate that. I think Bert and Heather and Terry are to be commended. They have done a fantastic job.
Outstanding.
This conference back on the schedule, and really have 450 people already registered, and I'm sure there'll be a few more between now and next week. And then over 100 people virtually. I think that's a great result, and it speaks about how valuable the International Factoring Association is.
Absolutely. Well, Mark, I thank you so much. I went over budget. I appreciate your time. Again, thank you for making yourself available to me and, of course, all of our peers in the industry. And I can't wait to see you in person in a week and a half. Thanks again, and we'll talk to you soon.
Brian, it was a pleasure. Thank you for asking me, and I look forward to seeing you in person next week.
Have a good one.
Take care.
To do environmental law, and when I graduated, there wasn't a whole lot of opportunity, so I kind of fell into the tax resolution industry, which is pretty common amongst our industry.